Welcome back to Talk Tickers, your deep dive into the most important calls coming out of the earnings circuit. Today, we're tearing apart the Q3 2025 results and outlook from ASE Technology Holding Co, Ltd ASX. And let me tell you, the enthusiasm coming out of this one was pretty palpable.
Oh, absolutely. It was an immediate market mover. You saw it right away in the trading. The moment these numbers hit, the ADR spiked. It really reflected what management delivered, which was this confident, accelerating story, where the AI supercycle isn't just like a nice tailwind anymore. It's fundamentally reshaping their business.
Right. It's core now. So let's start with that clean beat that really set the tone for the whole call. Q3 consolidated net revenue came in at NT $168.6 billion.
Yeah, which beat estimates pretty handily. The consensus was around NT $163.87 billion.
So that's nearly NT $5 billion better than expected. Significant.
And that operational strength, well, it flowed straight down to the bottom line, straight to shareholder value. Diluted EPS using TWIFRS, it absolutely shattered consensus, came in at NT $2.41.
Wow, NT $2.41. The street was looking for what? NT $2.08?
Exactly. So that's a whopping 16% beat right there.
And it wasn't just selling more stuff, right? They were actually running the factories better.
That's key. Gross margin showed, modest sequential growth, up 10 basis points to 17.1%. But look at the operating margin. That climbed a really healthy 100 basis points quarter over quarter, up to 7.8%.
Okay, 100 basis points. So where's that leverage coming from?
It's the sound of utilization rates ticking up. Management pointed right to it, higher factory loading. They said utilization hit the high 70s range.
High 70s, okay.
And crucially, this wasn't just one part of the business. Both ATM, that's assembly, test, and materials, and the EMS side, electronic manufacturing services, both segments beat expectations on sales and profitability. The leverage is clearly kicking in.
All right, let's pivot then to the segment that really matters for this whole structural AI story, ATM.
Yeah, this is the core of it.
This segment delivered record revenue, NT $100.3 billion. Sequentially up 8%, but look, year over year, up a massive 17%.
And what's fascinating when you dig into that growth is the mix. The testing business is actually growing like twice as fast as assembly this year.
Twice as fast?
Yeah, testing grew 30% annually. That's huge. And 11% just sequentially. And it's led specifically by chip probe testing.
Chip probe testing. Okay, why is that detail so important?
Because that's the bottleneck right now. Testing capacity, especially for these high-end AI and HPC chips, that's the immediate pinch point for the whole industry.
Got it. So those numbers, they look fantastic on the surface, but you mentioned they actually mask maybe an even better operational story.
Exactly, because the company was fighting a pretty significant financial headwind this quarter. We really have to talk about foreign exchange. FX was a huge drag.
Right, strong NT dollar.
Yep. The NT dollar appreciated 4.6% against the US dollar, just quarter over quarter. And for anyone less familiar, when your home currency gets stronger, like the NT dollar did, it means all those international US dollar revenues translate back into fewer NT dollars on the income statement. It artificially squeezes those reported margins.
Okay, so it makes the performance look worse than it operationally was. Did they quantify that drag?
They did. And props to them for being transparent about it. Yeah. They estimated that FX hit shaved 1.4 percentage points off gross margins at the consolidated holding company level.
Okay, 1.4 points overall.
And an even sharper hit at the core ATM level. 2.1 percentage point.
2.1% just from currency. Wow.
And this is where we get that kind of aha moment. The thing that really defines the true operational picture here. Management did the math. They calculated that if Q3 FX rates had just stayed stable, like where they were back in Q1, the ATM gross margin wouldn't have been the reported number. It would have been 26.8%.
Hold on, 26.8%.
Yep, 26.8.
So you're telling me the actual underlying operational health of their core AI and test business, it's almost 10 percentage points better than the headline number suggests.
That's exactly right.
That's not just margin resilience. That means they're already operating well within that long-term structural margin range they've talked about.
Right.
It was just totally hidden by the currency moves.
Precisely. Operationally, they are executing flawlessly, just masked by FX.
So what's the outlook for FX going forward? More headwinds?
Well, management expects it to stabilize, at least somewhat. For Q4, they're guiding using a more stable rate, around 30.4 NT dollars to the US dollar.
Okay, that should help visibility then. Before we dive fully into the AI strategy, let's quickly touch on the EMS side of the business.
Sure. EMS performed well too. Posted NT $69 billion in revenue. That was up 17% sequentially, mostly driven by the usual seasonal consumer product ramp-ups.
Anything notable there?
Well, interestingly, management mentioned that EMS is now facing kind of similar core engineering challenges, things like power delivery, thermal control. Just like the high-end ATM business, it really shows how complex system integration has become, across the board, even in more traditional EMS.
Interesting convergence. And tying all these operational costs and future plans together, what about the balance sheet? Are they funding this growth?
They are. I confirm their high conviction. Total interest-bearing debt did increase pretty significantly, up NT $55.6 billion to about NT $295.7 billion.
Okay, where did that come from?
Mostly from a big NT $50 billion syndicated loan, and they specifically earmarked that loan to fund capital expenditures.
So borrowing to build.
Exactly. Net debt to equity is at 63%, which seems manageable. It confirms they're investing in growth, not just, staying afloat.
Okay, good context. Shifting gears now to the absolute core, the AI pivot. They sounded really confident about their leading-edge advanced packaging or LEAF platform.
It's tremendous confidence. They reiterated they're on track for that really aggressive 2025 revenue target.
That was the $1.6 billion US number, right? For advanced packaging?
That's the one. $1.6 billion US this year, which, remember, is a giant leap from only about $0.6 billion just last year in 2024.
Huge ramp.
But here's where it gets really interesting, especially for long-term investors trying to track how long this AI supercycle lasts. Management actually provided a forward-looking commitment. They stated they expect incremental 2026 revenue of over $1 billion US just in that leading-edge space, fueled entirely by AI momentum.
Whoa, hang on. Over $1 billion incremental dollars in 2026, on top of the $1.6 billion this year.
That's what they said, over $1 billion more next year.
That forecast seems incredibly aggressive. I mean, let's put that in perspective. That one-year increase is almost as big as their entire advanced packaging business is expected to be this year.
It's ambitious, no doubt.
So what if, the industry suddenly standardizes on a competitor solution? Or maybe AI demand just slows down briefly. Is there any risk baked into that number, or is management just selling the hype here?
That's a fair question. But you have to look at their plan, which seems to support that conviction. They aren't just chasing general volume. They're focusing capacity on chips that need really specialized, sticky manufacturing processes. And to back up that $1 billion plus commitment for 2026, they're accelerating CapEx. Again,
CapEx?
Yep. They plan to further increase their full year 2025 machinery capital expenditure by, quote, a few $100 million US.
A few $100 million more. Okay. And is this CapEx allocation strategic? Or just general capacity?
Yeah, highly strategic. This increase is heavily weighted toward boosting wafer probing capacity.
Back to the bottleneck.
Exactly. For both AI and non-AI chips, actually. As we mentioned, wafer probing is that critical choke point. You need to ensure these complex, high-value dies are fully functional before they go into the really costly advanced packaging steps. So this investment isn't just about growth. It's about unlocking the entire AI production chain for their key customers. It makes the whole process more efficient.
Okay, help me square this circle, though. They're increasing CapEx by hundreds of millions to bring on new capacity, specifically probing capacity. But you also said pricing is remaining resilient. Doesn't new capacity usually push prices down eventually?
Normally, yes.
Yeah.
But that seems to be the structural difference in this AI cycle. According to management, pricing for both LE and even mainstream advanced packaging remains, quote, resilient and stable.
Stable pricing even with more capacity coming online.
It confirms that the demand signal, specifically for AI-related chips, is just so strong and so unique that any new capacity is immediately soaked up. They're getting that operating leverage from high utilization without needing price wars.
Pretty impressive position to be in.
Definitely. And they're also strategically positioning their own proprietary solutions too.
Right. They mentioned things like FOCO-S.
Exactly. FOCO-S, which stands for Full Chiplet Over Under CoWoS solution that signals a really crucial shift. They're moving beyond just being an outsourced assembler. They're offering these proprietary end-to-end platforms that can integrate complex dies for multiple customers.
So it makes them stickier.
Much stickier.
Yeah.
Deepens the relationship, makes them harder to replace. They expect meaningful revenue from these kinds of services in the back half of 2026.
Okay. And quickly on M&A, they firmed up that deal for ADI's Penang facility.
Yeah, a binding MOU is signed. Targeted completion is the first half of 2026.
Yeah.
This deepens their access into analog and mixed signal manufacturing. Good for supply chain resilience, too.
Got it. All right, let's look at the near-term guide then. Q4 sounds like it's shaping up well.
Looks strong sequentially, yeah. Consolidated revenue guided up 1% to 2% quarter over quarter, and the key ATM segment revenue guided up 3% to 5% sequentially.
Okay, decent growth on a high base.
And crucially, with that expectation of more stable FX rates, they forecast consolidated gross margin to increase by a healthy 70 to 100 basis points quarter over quarter.
Ah, so that's the initial validation. We should start seeing that underlying margin strength peek through as the FX headwinds lessen.
That's the idea. The first sign of the true margin story starting to unfold.
Okay, zooming out a bit to the investor context. The stock's performance has been, well, incredible.
Massive outperformance. The one-year total return is somewhere around, what, plus 62, 63%?
Yeah, something like that, which just blows away the SOXX semiconductor ETF. That's only up maybe 18 to 29% over the same period, depending on the exact timing.
So the market is absolutely buying into this AI pull structural growth narrative. It's not seeing it as just another cycle.
Did they address any ongoing supply chain worries, like bottlenecks for things like T-glass substrates?
They did get asked about that. Management basically said they haven't seen any real disruptions. And they kind of imply that, given their sheer size and dominance in the OSAT space, they generally get priority when securing critical materials. Scale matters.
Makes sense. Now, this raises an important point about geography, geopolitics. Lots of talk about building domestic supply chains, especially in the U.S. They mentioned evaluating opportunities for a U.S. footprint, presumably to support customers scaling up AI infrastructure stateside.
They did, but the CFO was, I'd say, quite cautious on this point. They really emphasized that any potential U.S. investment absolutely must make economical sense.
Meaning?
Meaning they won't just build capacity for the sake of market share if it doesn't meet their required margin levels. Profitability comes first.
Okay, that sounds financially prudent, obviously.
Fundamentally sound decision.
Yeah.
Prioritizing profitability over just reckless expansion.
But, devil's advocate here, in this environment, with huge government incentives and customers practically demanding domestic supply, isn't not chasing that market share, even if it's initially lower margin, potentially an existential risk down the road?
Yeah.
They seem willing to let competitors maybe take that less profitable domestic business for now.
It's a calculated risk, for sure. They're essentially betting that their advanced technology leadership and their existing highly efficient, high-margin capacity back in Asia, that's sticky enough that their key customers will continue to prioritize that tech leadership and cost efficiency over pure geography, at least for the most complex stuff.
A bet that margin is king, ultimately.
That seems to be the bet, yes.
Okay, so wrapping up the key things to watch going forward, catalysts. We definitely need that validation of margin expansion in the Q4 results. That's number one.
Absolutely. Proof that the FX normalization is revealing the underlying strength.
Then definitive agreements for that ADI Penang facility acquisition, probably by year end or early next.
Yep, finalizing that deal.
And then more details, more color on that incredibly ambitious 2026 incremental $1 billion plus revenue target for leading edge AI stuff.
Correct. Seeing how that develops and if they reiterate that confidence will be key.
The whole story really feels like a clear pivot now, moving beyond just a cyclical semiconductor recovery into real structural multi-year AI-driven growth.
The multi-year arc is now, I think, fully defined by this insatiable demand for advanced testing and packaging for AI.
All right. And that brings us naturally to our This Is Not Financial Advice segment. Based on everything we've heard, this highly confident call, the confirmation of that $1.6 billion LAP run rate, massive capex going into critical bottlenecks like wafer probing, and maybe most importantly, that hidden structural margin potentially near 26.8% once FX normalizes, the trade idea here really has to be leveraged, right? Betting on that secular growth story winning out over lingering cyclical fears.
I think so. If you connect this to the bigger picture, the market, despite this huge rally in ASX, still seems to have some leftover fear about the broader semiconductor cycle. And that fear creates opportunities, specifically in options pricing. The current implied volatility associated with the whole sector is still pretty high.
Okay, so what's our outrageous but plausible idea this time?
How about this? A combined leveraged position. You go long the ASX ADR common stock, but you combine that purchase with selling a long-dated, deep out-of-the-money put option.
Selling a put to help finance the stock purchase. Okay, break down the rationale.
The rationale is basically leveraging that fear premium.
Yeah.
By selling the put, you collect that nice premium because implied volatility is high, effectively lowering your cost basis on the stock you're buying. You're capitalizing on the market's lingering cyclical worries. But fundamentally, your core bet is that the long-term structural AI trajectory puts a pretty solid floor under the stock price, a floor that put option is unlikely to breach.
So you're betting the $1.6 billion run rate, growing to potentially $2.6 billion plus, provides enough support.
Exactly. It's a confidence play that the AI growth story is real, it's durable, and it fundamentally changes the valuation floor for a company like ASE.
A compelling pitch. Definitely capitalizes on a potential market inefficiency between cyclical fear and structural reality. Okay, so to recap the whole call, ASE delivered clean beats across the board. They proved impressive margin resilience despite those significant FX headwinds. And they really validated this tremendous confidence in their AI and HPC advanced packaging and test ramp, not just for this year, but accelerating into 2026.
Yeah, this is clearly a company making very high conviction investments. They're leaning aggressively into the highest growth, highest complexity parts of the semiconductor world right now.
Absolutely. And as always, please remember, everyone listening, that this analysis is purely for informational purposes. It is absolutely not investment advice. You have to do your own research. But it does leave you with, I think, a pretty profound question to mull over. What is the true lifetime value of one of these big AI chip customers to an OSAT partner like ASE? And how will that persistent, sticky, high-value demand maybe change the historical boom and bust cyclical nature of this business model over the long run?
Something to think about. We'll leave that thought with you.
Thanks for tuning in to Talk Tickers. We'll catch you on the next call.